I'm Nick Fox. I'm a partner at Europa Capital. We have a 10 billion euro track record across Europe, 19 countries, nearly 150 transactions, mostly up to now in the value add space. But the business is now diversifying and becoming more of a broadly based fund manager, involved in, for example, UK debt, European debt. We're launching a Core Plus initiative that will go pan-European. And we have a diverse investor base which spans our traditional area of North America now through Europe, through the Middle East, the Far East, and even Australia. So that's us.
Hi, I'm Martin Towns from M&G Real Estate. We are a global real estate fund manager headquartered in London. We manage about 30 billion euros globally. Majority of that is in the UK, where we are about 20 billion. And a very active investor in the UK market in particular, where we account for about 5% of all transaction volume in any one year. In terms of the strategies that we offer to clients, it ranges all the way from value add funds through to senior debt strategies, and the product types, open-ended, commingled funds, separate accounts, and co-investment opportunities as well. So a very broad range of activities.
Great, thank you. And Sungchul, thank you also for being the person who's travelled the furthest to be here today. Just give a brief overview of what you're doing at L'Etoile.
L'Etoile Properties is a French company. Obviously, we have offices in Europe and key cities, and I'm part of the L'Etoile operations, mainly in charge of the Seoul operations. I'm based in Seoul. So my major role is to bring the Korean capital into Europe for the acquisitions of the buildings, such as Novartis that we did with Larry in Paris. I've been bringing the Korean capital purely equity about the 600 million last 3 years, and since I joined L'Etoile, 1.8 billion of the worth of the asset we luckily managed to acquire in Europe.
Okay, great, thank you. Maybe Martin, just with you, in terms of the changes since we were last here at MIPIM, what are you seen as some of the biggest changes maybe in the flows of capital over the last 12 months?
I think over the last 12 months, everybody is obviously very conscious, probably increasingly conscious of where we are in the real estate cycle, particularly in the UK and in continental Europe. I think that, however, that's not really affected the flows in terms of what we're seeing, in terms of the aggregate level of capital that's flowing into real estate. People are still, asset allocators are still very much attracted by that income spread over fixed income. But I think that it's just important that we are conscious when we're doing underwriting these days that we are going to see some degree of increased interest rates going forward, and that needs to be reflected in prudent exit assumptions, for example. So I think a continued flow of capital coming in, but just everybody being very aware that we are very well into this cycle or close to historic lows in terms of those cap rates. We're seeing more capital coming out of certain countries. So we're seeing more capital flowing from Asia, and I think that was reflected in the slides that we saw a minute ago. Particular interest from Japan, where obviously they have extremely low interest rates, a lot of capital invested in fixed income domestically, and we're seeing that starting to emerge and be invested in global real estate. And we're also seeing a change in attitude from certain countries or regions as well. So Middle East, for example, where historically they've been seeking higher return strategies, we're actually now seeing more of an interest in Core Plus and in some cases even Core, so more income-focused strategies.
Okay, good. And Nick, are you seeing that as well? And also in terms of in terms of the outlook for capital flows, what are you expecting to see?
I agree with everything Martin's just said. I think the fact that we've got a huge growth story in Europe right now means that I think performance in real estate investments is going to be much more about rental growth than any further significant yield compression, although I could imagine in the core markets yield compression going on just a little bit more. Nevertheless, the yield gap to bonds is still pretty healthy. What I observe from my point of view, where we've just closed our latest Pan-European Value Add Fund, which is a total return fund, is that investors, whilst they love the handsome returns that we like to produce and often do produce, they have the headache of reinvestment risk. And I think that a lot of them are looking for a longer term perspective, more predictability of distributions through generation of income, and strangely enough, resisting the high total returns that could be possible through closed-end funds, and instead enjoying the longer-term perspective, possibly lower risk perspective that comes with an open-ended style investment or a more income-based investment method.
Okay, good. I wanted to pick up with you, actually, Larry, just in terms of, there's been a lot of discussion, obviously, about interest rates, where we are in the cycle. What's your sense of that, and how do you think that might influence global capital flows if there is a tick up in interest rates?
Well, I mean, I think as Nick mentioned, maybe there is a little bit more compression in some of the markets, and over the last, I think, couple of years, the amount of predictions of yields are at the lowest level we've ever seen. They've carried on going down, and there is still this spread between prime yields and between lending rates, especially in the eurozone, where you can get some very interesting lending. And I mean just being at MIPIM, and despite the weather today, I think most of the meetings we've had has been more net investors than net sellers. So I think if there is any move following interest rates, it seems that it will be slow. And I think a very good point that Nick mentioned as well, that the difficulty and the headache of deploying capital is really the key. From what we've seen on capital flows last year, of what we're seeing this year, there is still this big weight of money. So I think investors are going to try and find different asset classes. There's a lot of talk about alternative investments, a lot of talk about maybe investors sort of getting, say, back into retail, because retail's obviously been fairly blown out by the e-commerce side, but I think there could be some opportunities there. Logistics has been an incredibly hot market, probably the hottest market of anything, again linked to the e-commerce part with the likes of Amazon. I think that there's a bit of scratching the head on where yields are going to go, but our view is nothing's going to change dramatically unless there really is some huge economic or political shock.
Okay, good. And Martin, in terms of your view on interest rates, you mentioned that you were largely invested in the UK. Interest rates going up, probably likely to go up a little bit more, maybe not hugely, but does that mean that your fixed income guys are now suddenly delighted and are going to be trying to take capital away from the real estate side? How do you see that? Where do you think the sort of institutional capital is really looking in terms of that fixed income versus real estate?
It appears at the moment to still be very much looking towards real estate. So when we talk to the asset allocation teams within our wider group, there's still very much a view that real estate is offering fair value at least, and unusually offering pretty good value relative to those other asset classes. I think, as we touched on earlier, there is obviously an expectation that interest rates will rise. I think that again, as I mentioned, you can factor that into your assessment of prospective returns from every asset class, and real estate is no different. So when you are looking at longer hold periods, and I agree, increasingly investors are looking at, say, 10-year hold periods rather than 5-year holds, because it's very expensive to trade. Over that time horizon, you do need to be building in some degree of expansion in that exit yield, because you'd expect that rates will be higher at that point. But if you do that, and therefore you're messaging to your clients appropriately in terms of the total return they can expect from the sector, from the asset class, then I think that's the job that we have to be doing as real estate investment professionals. Being clear with our clients about what we think prospective returns are likely to be going forward. In terms of the UK, you mentioned we're a very big investor in the UK. That's the case. So we are about 20 billion in the UK. And obviously everybody is slightly concerned with the outlook for the UK real estate market during the Brexit process. And we're actually finding that there are particular opportunities being presented by that uncertainty. So we held a first close for a UK value add fund at the end of last year. We're currently deploying that capital and seeking to raise further capital later for a second close. So really we're seeing opportunities to take advantage of some of that risk aversion, which is prevalent at the moment, particularly in markets where actually there's pretty good supply-demand dynamics on the occupational side. So if you can buy shorter leased buildings or buildings that need some capex applied, we're actually seeing some pretty attractive relative value in the UK market in doing that.
Okay, good. And quite often in these panels, we have people talking about what Korean investors might be thinking about, but actually we have the benefit of having Sungchul here. So Sungchul, just give us an overview, if you can, on what's in the mind of the, and I know all Korean capital is not exactly the same, but just give us an idea of what the attraction is in terms of the European market, and also what sort of opportunities that capital is looking for.
It was a very, very difficult question, especially when we talk about the interest rise environment. Probably some of you know already what the Koreans like about in Europe, long lease, key cities. So the typical preference for Korean investors were, the long lease in the key cities, a nice quality building. Instead of having the multi-let the buildings, we prefer the long lease, the office buildings, something like that, or some logistics. But that was the main trend of the Korean capital for the past 2 to 3 years. But actually, the evidence of what was shown in the United States, because actually this interest has gone up, and then we have an issue with whether equity investment is still doable in the United States. So Korean investors have already saw the situation in the United States. So then now they mirroring back to the investment in Europe. Although in Europe the interest rise is not really coming dramatically as you pointed out. But the key concern this year is that what kind of strategy in terms of investment could be like an interest rise mitigation strategy. That is a really important actually strategy this year. And then probably you know that the why Korean investors were active in the past, but because we have the additional the hedging gains, there was a little plus from the making investment into euro from Korea won. But that the FX gains is still available, but the price, every asset price has gone too much up. So then now we are looking at some sort of interest rise situations in the future. Then the key concern is that then what kind of asset, what kind of the risk profile that we can protect the terminal value in the end, if we have to still keep doing the investment in Europe. So maybe this year the Korean investors may not come that big as before. They may be selective this year, but the Korean money is really risk-averse kind of money, as you know. So I don't think that they're gonna go to like a value-add or opportunistic opportunities in Europe. So it's a very difficult moment at the moment.
Okay, good. And Nick, in terms of, you're obviously been at various points capital raising for different types of funds, including student housing and various others. In terms of the types of global capital that are interested in the specific products that you're taking to market, what are you seeing? Are you seeing different groups of investors interested in different sides? What's your view on the fundraising side and what they're attracted by?
Yeah, it's a hugely diverse field. I would say that a lot of investors coming into to Europe, whether it's into a specific country or specific sector, may well have researched Europe sufficiently to be deciding to pursue a very specific strategy where they see a shortage of that kind of accommodation. So, for example, student accommodation in the UK is undersupplied, particularly in terms of demand from overseas students, and that's overwhelmingly non-European. It's typically Asian, demanding a higher quality of accommodation and so on. Where that research has revealed the dramatic shortages that do exist, I think the investors we're addressing have already bought into the idea, and the question is, do they pursue it with us, or do they find another avenue? It's not a sector, and things like this are not easily accessible without a structure set up with expertise in the sector to create and then manage the product. But equally, a lot of investors come out of their home markets in order to achieve higher returns, and those are the kind of people that we would secure in the value add business, where we're looking for net 15% IRRs, and we try to do about a 1.5 times net equity multiple. That will appeal to another kind of investor. But as I said earlier, I think the trend, possibly because where Europe is in the cycle, is towards a desire from a large institutional investor base towards a predictability of income, a stability of income, the possibility to build on Europe's growth in order to capture rental growth, which is now forecast over the next 2 or 3 years, but where they're not looking to have their capital returned to them in 5 minutes' time and then have the reinvestment headache. So it's a range of things to a range of investor types. My observation from what I know of Asian investors, and we obviously have a strong relationship with Mitsubishi Estate, our principal shareholder, is that I think there is a desire for lower risk strategies to some extent, at least to get a toe in the water and see how things work, to build relationships here, to understand how things work. And obviously the risk right now arguably is that that decision could be made at a time when we are late cycle. And of course the last thing you'd want to happen is to come in late, having spent years researching it, and dive in and then see the markets correct. So we hope the markets won't be correcting anytime soon, but hence the low risk strategies will appeal to a certain kind of investor.
Good. And maybe Larry, just give us an overview in terms of the types of sectors that people are interested in. So, for example, student housing is one element, but you've also got healthcare. You've got those alternatives which have been creeping up in terms of the investment view. Is it really those kinds of alternative assets that are interesting opportunities for this kind of global capital, or really are they looking at the more standard, let's say, office, retail, logistics?
I think as Nick mentioned, you've got a lot of diverse capital out there in the market, and that the markets have still been dominated by the office sector. I think we were about 60% in terms of investment volumes. So investors like not just the South Koreans, but what we've seen from some of the Hong Kong buyers, also Singapore buyers have been generally dominated by the office market, and then I think similarly with Middle East and US investors. Retail, we touched on it before. It's in a slightly difficult moment with what's happening with e-commerce, but I don't think that shows the full story, because high street retail is generally still okay in most markets. Dominant shopping centres are generally okay as well. I think it's more the sort of mid-level retail between the two, but that's actually providing some opportunistic investors who are looking at those sort of deals as well, mainly the private equity funds from the US. Logistics, as mentioned earlier, has been really the hot sector. Some big deals with the likes of tenants with the likes of Amazon and any of these other e-commerce sectors, and I think that's going to carry on. Logan, who's on our logistics sector, is smiling at the back. In terms of alternatives, I think the issue is they're not very advanced markets. I mean, I think UK is probably quite a long way ahead in terms of student accommodation, retirement homes, but as soon as you get into continental Europe, there just isn't the sort of volumes, there isn't the knowledge, the advice. So yes, I think we'll see that increasing, but I don't think things are going to change dramatically in terms of the mainly office weighted markets.
Okay, good. Martin, I mean, Larry raised an interesting point there, and also in mention of Logicor, and that seems to have been, to me, one of the big trends of last year, is just the platform purchasing, but from international investors. So you've had P3, Internos, Trigranite, so across, from developers through investment managers, through specialist developers like P3 as well. So what's your sense of that? Is that a growing trend? Is that because people just want a way to be able to get a large amount of capital active in the market through a kind of trusted partner? Or that it's just very difficult anyway to access assets, and this is just an easy way? What's your thought? And do you think that trend will continue?
I think if you are a large, international investor coming to a new market and you want to do something which is scalable, and you need an operating partner on the ground who really understands what they're doing, then it's a very logical thing to do, in my opinion, to set up a platform, and perhaps also to take a share in the operating element of that platform, because if you're going to put a lot of capital through it, then it can make sense to share in the value that is created from doing that. And maybe we're seeing that number of platform deals as well, because a lot of the capital that's flowing in is into more operating type asset classes, where having that operating partner is even more important. So maybe a little bit less so in logistics, but when you look at the likes of student accommodation, for example, then if you're a large investor, then you need to be teaming up with a reliable operating partner who you can build it out with on a programmatic basis. But I think, just touching on those so-called alternative sectors, I think what we're seeing is capital flowing there because there is a structural driver of future returns. So when we're at a point in the cycle where yields are relatively low generally, you obviously need some sort of driver of income growth. And where you have an undersupplied market, be that the private rented sector in the UK, which we're now a very significant investor in, there's obviously strong sustainable demand, there's a lack of supply, you can reasonably anticipate you'll get income growth, and that's going to drive total returns. I think it's the same with student accommodation. I think it's the same with aged care as well.
Okay, good. Sungchul, just coming to you, I wanted to look a little bit about geographies, whether they're countries, regions, cities. Are there, you mentioned that Korean investors are quite cautious. Does that rule out a number of countries? So where are people, are they looking? Does that mean that CEE, for example, is less attractive, or even Southern Europe potentially? What are the sort of geographies, cities that they're happy and comfortable with?
I think that from the last year, until up to now, the investors are trying to look for some alternative or replacing reliable cities for as a destination of investment, such as Warsaw and Dublin, Barcelona. Those instead of the Western key cities, we looked at a couple of those cities. There are deals done by Korean investors, one or two out of those areas, but it cannot be. It will not be the mainstream for Koreans. Like what the mainstream for the Korean investor were, like Frankfurt or Amsterdam, or Paris or London. The Korean investors still wants to hang around those key cities. I mean, this is a little ironic, but. So the strategy this year is for them, the investors, is that then we don't want to go a really alternative type of asset like a student housings or senior housings, because that's really local product to the minds of the Koreans as a foreigner. So we want to stick to the conventional, typical the type of asset which can be mainly office, and also the logistics is a kind of another opportunity, the windows open to Korean investors. That's what we think. So we really actively think the logistics of the assets this year. And also as we did in a full purchase deal when the lease is fixed, but instead of buying when it's completed at a core price and when the cap compression is already there, so why don't we come a little earlier in buying out the development? That way we could avoid a little bit of a price competition. So probably key cities for purchase type of deal and logistics in a key logistics area. Probably, and also you can change the little bit of a form of investment, which used to be like equity. Then probably the investor can come as a mezzanine or preferred equity, some form of a debt into the acquisitions.
Okay, good. And Larry, are there sort of, just looking more broadly, are there kind of no-go areas? For example, Greece was a no-go area, but it seems to be coming back onto the map again. But I'm guessing that Russia and even Nick shivered there, so Russia is out. But Russia and Turkey, for example, Turkey was very hot a while ago, but now not. So where will people invest in terms of international capital, and are Russia and Turkey kind of shut off from that? What's your sense of it?
I can't say that I'm an expert in either the markets. I think international capital will really go to any European markets where there is political stability, where you can get financing as well, and I think the key point is that the three large markets still dominate. They account for roughly 60% of investment volume, so UK, France and Germany. I mean, as was mentioned, even though yield levels are low, these are the really big liquid markets where you can get the large lot sizes. And then I think, I'd just go back and for other global locations, as long as there is stability, as long as there's growth, then you will get international investors for all these markets, but it will be the more advanced investors, the big sort of US private equity investors that invest everywhere in the globe. It will be less, I'd say, we've said a bit about the South Koreans a few times, or I'd say the sort of less of the new investors that will come in and really focus, especially on the gateway cities, despite yield levels being really low.
Okay, good. And Nick, Europa are obviously invested in CEE. What's your? Do you have concerns over political changes in Poland? Hungary now seems to be very investable where it previously wasn't. What's your sense of that in terms of some of the changes in terms of politics in these countries?
Well, it's a moving feast, of course, in Europe. We've had political risk in the UK for a little while, for example, in what has always been the largest market. But I would say, we have to remember 10 years ago we were at the beginning of the most terrible correction in our markets, and I guess the industry that we're in tends to suffer memory loss. I think we tend as an industry to look at fringe markets, smaller markets, and also alternative sectors at a time when we're struggling to deploy capital where we'd really like to be deploying capital in the larger markets with great liquidity. So, of course, on a measured basis, one should invest in different markets to achieve a balance of risk and reward. But we should be careful about liquidity, which tends to evaporate in some places when markets correct. It's not necessarily a relative issue, it's a matter of a binary illiquidity when markets correct. So we've learned a lot of lessons ourselves in terms of where we would go back. I think in terms of, let's call it alternative sectors, I think I heard this week that no more than around 12% of capital into Europe goes into these alternative sectors, and I'm including healthcare, I'm including student accommodation, nursing homes and the like. For our part, and I think a lot of investors take this view as well, sectors that require a lot of intensive operational exposure come with a different level of risk, and the rewards for investing in those sectors need to be commensurate with those additional risks.
Okay, good. I mean, we're nearly up against our time now, unfortunately. But does anybody have any questions? Or Andy, yeah, go ahead. Yeah, I'll come over to you.
Thanks, Richard. So we heard from Larry that times are good, yields still floating down, rents are rising up. Good for investment managers to look good, deliver good performance, for agents to have good volumes. But we learn more when things go wrong. So I'd like the panelists to share with us, if they can, something in the last year that's gone wrong and what they've learned from that.
I have to say, it was about 12 months ago that we were looking at a large residential deal in Berlin at going in and going out yields that were frankly eye-watering. We didn't do that deal, and the yields now are even more eye-watering, which suggests that we would have made an awful lot of money if we'd done it. Hindsight's a wonderful thing. I don't think I should beat myself up too much about that. We need to be measured. We have an investment committee process for a reason. We need to protect our investors' interests and demonstrate care and caution. But we missed out in that case.
Okay, good. Anyone else want to admit to any...
I'll give it a go on one thing. I think predicting what's happened with the Brexit, I think, is quite an interesting one. I don't think anyone's got that one right, because on the property market side, everyone thought, with the Brexit vote, it's going to be a complete disaster. Markets would massively crash. And, rental markets did correct in the UK. But we saw on the slides earlier, almost 25% increase in investment volumes. Rental markets is stabilizing. This isn't me predicting what's going to happen when Brexit finally happens, if it does happen. But I think, there was a lot of predictions that are wrong. And there was also, a lot of predictions of all the banks leaving London. We've seen some moves. We've seen some banks go to Frankfurt. We've seen it in Paris. We've seen it in other markets. But I think the horror stories haven't played out so far as much as we thought they would.
In the immediate aftermath of the Brexit vote, I think we were probably a bit too bearish. I think we were arguably slightly too inward looking. I think you need to sometimes step back from your own domestic market and think about it from the perspective of some of the international capital in particular, which is coming into the country and coming into the region, because there's still a number of reasons why the UK is attractive to international capital, and I think that will remain the case. But just sounding an additional note of caution on that, Brexit hasn't happened yet. So I think that we still need to be suitably cautious, because there's still quite a lot to play out, including the actual event itself.
Okay, good. So I've got one last question, which is let's start with you, Sungchul. Just in terms of the big trends, what do you think the big trend or the biggest trend that you see for 2018?
Again, there is a lot of the still in Korea within. We have the really strong still pushing demand money to go outside still. So one of the panels mentioned that we have to play with the environment, the market conditions that we want to go. But as I said, that the Korean investors are really risk averse. They want to hang around the cities they're already comfortable with. So it's a matter of in Korea also the new trend from Korea as a source of money, of capital, is the public retail funding, which is happening right now. But this is really different from the existing institutional source of capital. So we have this attempt to raise through those retail channels, but still, so the long lease, nice quality building in good location, in core location, a prime location will be still attractive to Korean investors. That's gonna go on this year. That's what I see.
Okay, good. Martin, what's the biggest trend, do you think?
Probably a couple of things. I think continued increase in flows into alternative sectors. I think because of the obvious structural drivers of demand, I think we'll see more long-term institutional capital flowing there. Apart from that, I think that we will see a continuation of this theme around institutional investors taking a longer-term approach in their investment strategies generally, and probably a bit of a continued shift from higher return strategies into more income-focused, long-term investment strategies, with the exception of where you can see a specific market event that you can craft a strategy around. And actually, we'd put the UK in that box at the moment, differentiating from many other countries around the world where pricing has continued to march on. But with the volatility created by the Brexit process, we think there might be some interesting opportunities as a consequence.
Okay, good. Larry?
I think what we're seeing is, as well as I've spoken a bit about the three big markets, I think the other markets have seen more and more interest, and as their economies recover, as we've seen political stability in the majority of the European markets, which wasn't the case about a year ago. I think we're seeing markets like Italy, like Spain, like the CE, like the Nordics. We're seeing investment volumes increasing in those markets because of all these points, and also probably because of some of the very low yield levels in the big markets.
Good. And last but not least, Nick?
I think we'll see a trend in agents' fees reducing. No, I'm kidding. No, I think maybe a couple of things. Larry earns every penny, believe me. I think we're going to see the development tap turned on big time. I think for good reason, because there's a lack of stock, particularly in the strongest markets in Europe. We have strong rental growth, and I think the developers, followed by their financiers, are going to see the tap turning on, I think, in the next year or two. Hopefully in a controlled way. It's been very controlled up to now. There's been a great discipline among the lending community, but I think that will loosen up, because I think the lenders appreciate that development needs financing to get moving, and not everything can be pre-let, and we need more space. And the other thing perhaps is that, and I maybe would say this, wouldn't I, but I think we'll see the wall of Japanese capital begin to come this way in a more meaningful way. We have a Japanese investor in our value add fund. That's a new thing. We have a Japanese investor in our UK debt fund. I think we'll start seeing that increasing and coming into all sorts of relatively lower risk strategies to begin with, and some very sector specific things.
Good. Thank you very much.